following is an update and technical analysis on the U.S. equity markets as well as the 10-year Treasury yield, where we had the CPI data initially triggering a flurry of market activity with yields surging, stocks tumbling, dollar strengthening, and a rate hike expectation soaring. However, this turbulence was short-lived, with rate hike probabilities for the upcoming week, following week, next week, quickly plummeted to near zero, leading to a significant reversal in the bond market, taking big tech stocks with it in its wake, and then margin calls consolidated briefly throughout this intraday session, followed by margin calls adding to extreme selling pressure, resulting in a session characterized by intense volatility in both directions. Looking ahead, the Federal Reserve and the White House may face challenges within Q4. While inflation currently dominates the conversation, you had Goldman Sachs anticipating the factors like the resumption of student loan payments, potential temporary federal government shutdown, reduced auto production due to a potential UAW union auto worker strike, which could impede U.S. GDP growth in the fourth quarter, with additional signs of economic strain are also evident within the auto market, where I recently observed this past weekend a substantial discounts on new cars at dealerships. And it appears that a dose of reality has now dawned on consumers when it comes to major purchases that involve financing. Those who previously had the means and perhaps made unwise choices in a rising interest rate environment have largely exited the market, with those who remain either cannot afford these items at current prices or recognize the imprudence of purchasing now within these levels. And the looming question is when the Airbnb fleet, who may have invested heavily within these markets, decides to panic and offload their assets. When that day arrives, the potential consequences could be nothing short of epic. And we'll deep dive straight into the S&P 500 futures right off the daily interval, and we were safeguarded. Bull traders, long traders defended the 44, 45, 70 price support really to the button, multiple 3 days in a row there. And what was more significant was the rejection right up amongst the 786 fibs retracement and really to the button, especially if you're an active and or day trader. This has been your trading range and trading zone for a multi-day continuation rally down to the downside for a 1% tumble, and really, again, once again to the button, right off the 44 or 45 price support, was heavily bid today, which was perfect on a perfect retest tag of the 50-day moving average for 0.8% move to the upside, especially, again, once again, if you're an active and or day trader. That was a bid. An amazing consolidation phase. And I believe this is your key trading range within some additional retail sales tomorrow, triple quad witching coming up on Friday. Just a ton of, once again, starting 9/11, the week of 9/11, with just a plethora of economic data, and then followed by the Federal Reserve next week in their rate cut decision. But these are the key levels to watch. These are your key levels right off the primary reactionary March reactionary lows here. And again, I cannot stress how major this key price support level is, and that will result in either a potential breakdown sell signal, or whether it's defended heavily there by long traders and or bull traders. That will be the ultimate level for the near term, potentially the most critical and major transitioning point of the year, and that will be a retest of this primary uptrend line. We do have this consolidation range, primary trend range potentially forming here, where we could get another balance rejection, and then just a huge amount of consolidation if and when where bull traders, long traders want to break out above that take out the 786 fibs retracement to go on a rechallenging of the 45.28 price resistance, where we were rejected impulsively 3 days in a row there, right off that key inflection point, resulting in a nice, quick, swift tradable drop to the downside. And then additionally, bull traders, long traders, they need to defend the 44, 22, 20 price support correlated with the primary uptrend line support really at all costs. Take away all the lines. And these are the key levels right off that gate there. Zooming you in a little bit closer there, the 44, 22 price support, multiple reactionary highs and lows to strengthen the validity of that price support level, which would, again, be a dual line of price support if and when we go on to retest that pivotal major key inflection point. Bear traders, short sellers, they want to see a big daily red candle close breakdown sell signal below to trigger a sell signal here off the daily interval, which would be the most crucial moment from a technical perspective of the entirety of the year, in my opinion. Whereas we do have a potential bearish crossover here in the moving average convergence. Again, that is a key inflection point within the technical momentum indicator realm, where you'll have either a whipsaw-like reaction, where you'll have that slip and slide, ultimately whipsawing it into a bullish potential bullish crossover, or we're going to get that bearish crossover taking with the producer price index and the retail sales tomorrow. It could be a substantial move to the downside to retest these primary dual support levels if and when we get there. But again, just big monumental key inflection points to watch where you have the 100-day moving average hovering in down below, correlated with the 618 fibs retracement. Taking you to the US Tech 100 futures here off the daily interval. And we are, again, retesting this primary uptrend line. Call it a very minor uptrend line, really to the button, right off the 786 fibs retracement. Once again, bid right to the button there, especially if you're an active and or day trader. Netted you 1.12% in a single day there. And here we are, potentially honing in on the primary reactionary downtrend line right off the July reactionary highs. And I believe this will be your most valuable short trade, objective short trade, if not an existing add-on to your position, if and when we go on to retest this key inflection point for a great risk-reward ratio to the downside, to re-challenge the 786 fibs retracement and the 50-day moving average there, and then ultimately the major primary reactionary uptrend line off the January reactionary lows, and that is going to be, again, once again, correlating and synchronizing with the S&P 500, the most pivotal major key transitioning point of the year there, if and when we go on to retest that key level, which we could put in an additional reactionary high amongst that primary downtrend line, retest the 786 fibs retracement, and correlating with that primary uptrend line. And once again, short sellers are just salivating at the mouth for a retest, backtest, and a red candle close breakdown sell signal for the next objective entry big short to the downside, ultimately retesting the 618 fibs retracement, 14,558, and the 50% fibs retracement at 14,330. Whereas bull traders, long-term investors, they need to defend this primary uptrend line really at all cost to avoid that sell signal, and then ultimately break out, have a monster green candle, daily candle close above that key primary reactionary downtrend line, ultimately retesting the 15,718 price resistance, and then honing in on to re-challenge the 16,002 price resistance, correlated with the 1% fibs there at 15,920. These are your major key inflection points to watch. And again, we have a confirmed nice steep gaping crossover, bearish crossover here in the moving average convergence. And again, we're at that key major technical momentum indicator dimensional pivot point where the bearish crossover sell signal could get inverted in a much larger move to the upside. Whereas you have these stochastics 1033 just crashing down in a bearish crossover abyss. So that is a very early indication in the stochastics of a breakdown. But again, that moving average convergence, bearish crossover, and a momentum fueled overshoot right back, breakdown below that zero line threshold ought to really retest this primary uptrend line. And then again, that breakdown sell signal would be an epic, with a potential backtest scenario, counter trend rally for a much larger drop on a big move to the downside. Zooming you into the 60-minute interval of the US Tech 100 futures, and we have had just a continuous amount of reaction right across the board here. I had paid attention and made minor primary reactionary uptrend line was, and watch for a breakdown sell signal and an hourly candle close, and we got that breakdown sell signal. Ended up having a nice clean hourly candle close, flirted with the 15,344 price support here, ended up having a nice steep counter trend rally, came shy of hitting that price resistance, ended up coming back down on a nice clean sell off down below, which was good for the entirety of that move, was good for a 1.3% drop. And we ended up retesting the daily 15,281 price support and the 15,263 hourly price support there, and we ended up bouncing right off of it, really to the button there, rejecting, backtesting, once again, retesting, backtesting again in this huge consolidation phase, had a breakdown, potential breakdown, whipsaw-like reaction, bear trap, it's taken in a whole ton of a short squeeze setup, and if you pay attention right to the button, right off that key inflection point, we ended up getting bid heavily right off the 15,263.40 price support, all the way up to the third target at that 15,416 price resistance. And that was good for a whole percent move to the upside. And again, once again, right to the button was where we were rejected impulsively for another 0.7 of a move to the downside. I would say pretty bullish that we practically have retraced this entire move, this entire drop, where we had that hourly candle close sell signal, and we've retraced this move, backtested amongst that key inflection point, held with 2 wicks on a whipsaw-like reaction, bear trap, and got bid really to the button off this hourly candle here, and we are steadily trying to climb up higher, whereas you have the stochastics 1033 divergence, nice clean, what you would call a positive divergence, bullish divergent amongst the stochastics 1033, and this looks pretty bullish, where again we are at a key technical posture where we could have a bullish crossover and a big move to the upside. especially with that data drop tomorrow. The markets like it and go on to re-challenge where bull traders, long traders want to re-challenge the 15,416 price resistance and the 15,429.50 additional price resistance up above, where you can additionally make the case for a trading range right amongst these key inflection point price support and resistance levels, where we have the middle of the trading range, top of the trading range, and we could get some sort of consolidation phase heading into the quad witching hour. But again, that would bullish if we break above, bearish if we break down below, and then ultimately re-challenge this, what I have a minor primary uptrend line off the mid-August reactionary lows there, and that could spell for a nice long trade setup on a great risk-reward ratio on prolonged move to the upside if and when we go on to re-challenge it. And then ultimately, I've been hyping up. I will zoom you in on this primary reactionary downtrend line that I've been hyping up for quite some time now, and you can see just continuous reactionary highs right across this entire sphere here. Great wick-like reaction amongst multiple reactionary highs and lows as well. And this has been a key inflection point that I really like here. And we'll sort of zoom in here, and then you can see here additional reaction right across this entire sphere here. Reactionary high, reactionary low, rejection. And again, just wick-like reaction right across that entire sphere. But again, that will be the most pivotal moment for short traders and or bear traders, where I believe that will offer the most generous risk reward ratio on a short trade setup on a big move to the downside if we go on have a big, steep, momentous counter trend snapback rally, and that would be the ultimate great risk reward ratio setup on a prolonged move to the downside, correlated with the 15,551 price resistance up above. Taking you to the US 2000 Russell futures here off the daily interval, and we are testing this primary reactionary uptrend line that I previously noted, where we had a initial reaction at first and then was just sold off into the close here. But that is a key inflection point. I've added this new benefit of a doubt primary reactionary uptrend line, multiple reactionary lows here, and here we are at a key monumental inflection point, located and synchronized with the 236 fibs retracement and the 1819 price support down below. And that is going to be the big price support level, that major price support level that I've been hyping up and harping about in these previous videos. That is going to be the ultimate inflection point, which I believe is the neckline to this head and shoulder classic looking top. And that will be the ultimate breakdown sell signal if we take these levels out. Bull traders, long traders, they need to step in pretty aggressively, pretty considerably within the next few days, few trading sessions, to avert a potential sell signal, maybe even a potential backtest, the 18, 19, 10 price support, and then ultimately whipsaw-like reaction and recovery of the primary uptrend line on a prolonged move to the upside to either re-challenge the 18.99.30 price resistance and additionally the 19.54 price support up above. Whereas bear traders, short sellers, they want to see all these levels go, stops to go off, margin calls to go down, and a big, solid daily candle close, breakdown sell signal down below for a prolonged move down to the 17.26 price support, which would be a huge move considering the divergent high. We had negative and bearish divergences amongst all three technical forward momentum indicators, which was the direct catalyst for a big, large move to the downside. And taking out that neckline would only increase the stops and cause an emergency rush for the exits, in my opinion. Where we have an additional bearish crossover here in the moving average convergence, already sinking down below its zero line thresholds. So again, there is damage within the technical momentum indicator space here in the Russell 2000 futures. Zooming you into the US 2000 60-minute interval, and again, I believe we're at a key inflection point as of now, where we do have additional potential, a positive divergent with a divergent low in this beautiful bullish falling wedge pattern. So again, if you've been short off this breakdown, this primary reactionary uptrend line has been a great short setup. You ended up having that nice clean breakdown sell signal, and it has been nothing but just a remainder 4.2% crash and selling for an entire index there. And here we are, especially if you're still short within this trade on a great risk reward swing trade setup to the downside. You may think about covering if and when we go on to retest some of these key inflection points, the 1844 price resistance and the 1851 price resistance, major price support, price resistance here on the hourly interval. And I really like this key inflection point. Cuts through just a ton of reactionary highs and reactionary lows, which will correlate with the primary reactionary downtrend line here off this bullish falling wedge pattern. And that will be the dual price support level to hone in on watch. And if we break out, bull traders, long traders, when I say strong hourly candle close breakout above that key inflection point, which I believe would scatter short trade setups and or anyone who was bear traders who were short amongst this breakdown sell signal and rode this entire big drop move to the downside, need to think about covering their shorts on a potential bull stampede rally on a big move to the upside, squeezing out a ton of shorts. And I would only suspect a emergency exit doors for all short sellers and or bear traders breaking that key inflection point. So I believe if we take out the 1844 price resistance with authority and go on to re-challenge the 1851 price resistance, I believe that moving average convergence will have a bullish crossover confirmed there, re-challenging the zero line threshold. So again, that is going to be the major price resistance of all resistance in the near term for the small cap futures. That will ultimately potentially puncture right back above the zero line threshold, confirming with all authority and conviction positive and bullish divergences amongst all three technical momentum indicators, just pouring and spurring health back into the dimensions. Taking you to the US 10-year Treasury yield here off the daily interval, and I've continued to hype up the primary reactionary uptrend line off the September 2020 reactionary lows, and this is going to be the multi-year, call it multi-year price support level. All traders, algorithms, computers, bond traders, this is the ultimate price support level to watch, correlating now with the 420 price support level. Talk about a great risk reward setup on a prolonged short. Big drop to the downside on the 10-year Treasury short if and when we go on to retest this dual price support level correlated with the 420 price support. I believe short sellers will be salivating on the mouth for a much larger, big move to the upside if and when we start to see an implosion within the Treasury markets with some additional stops below. I believe it creates a great risk-reward ratio, which would spur chaos within the Treasury markets, confirming an economic stagflationary environment.